Good morning, everybody. I'm going to start 2 seconds early. So I hope everyone's had a wonderful conference. My name is Jeb Burns, and I'm the Chief Investment Officer at the MERS in Michigan. And one of the things I've discovered since coming up here is Dale was not lying during the vote yesterday. You literally can't see a thing out there with the lights. So what I'm going to do today is I'm going to talk a little bit about portfolio performance, but more importantly, the philosophy which underpins what we do. So I hope at the end of the day, you have a better understanding for the why of what we do, how we invest, and where we're positioned today. And then when I'm done, I'm going to step over here, and our investment committee chair, Jim Wiersma, is going to facilitate a conversation with another investment committee member, Mike Gilmore, and members of my staff. So here are the key areas we're going to talk about. We're going to go over fund performance, an update on the asset allocation, which we do every 3 years, and we made some shifts. And then we're going to kind of talk about a market update, kind of where we are in the business cycle. So here's performance, and this is as of June 30th, so end of the second quarter. And you've got the trailing 1 year through the trailing 40 years. And what you see here, the MERS portfolio is the green bar. And beyond the 1 year, we're outperforming our policy benchmark for all time periods. So what this means is the active decisions that the team makes managing the portfolio, and more importantly, the asset allocation that the board selects is added value. I think one of the other takeaways, you might look at this, because you see the purple line is the S&P 500, and you might say, well, why didn't we just put it all in stocks? And I think as I go through my presentation, I hope you come away with a better understanding about why we don't do that. So what this shows here is asset class drawdowns since 1994 through 2018. Over time, the stock market generally goes, over multiple, decades, it's on an upward trajectory. But, day to day, week to week, month to month, there's drawdowns in the portfolio. What this shows is the two major spikes down are the dot-com bubble in the early 2000s and the global financial crisis in 2008. And what you see there is, over 40% drop in the S&P 500 and over 50% drop in 2008. And the MERS portfolio is the green bar. So what you see is, now we're impacted by the market, so we were definitely down, not nearly as much as just an equity portfolio. And we bounced back much more quickly. And that is by design. Because at the end of the day, we're a mature plan. We have a lot of pension obligations, and we simply can't take that extreme volatility. So what are we trying to do when we structure the portfolio, the mix of stocks and bonds and other alternative assets? So what we're trying to do, if you see that black dot or black diamond in the middle, that would be the policy benchmark. So if you just invested the portfolio in a passive mix of stocks and bonds, that shows you the risk and return you could expect. The bottom line is the standard deviation, which is how much volatility, how much up and down the portfolio would go. And on the far left, those are the return expectations. That black dot would be the MERS portfolio. So what this shows is we've been able to design and construct a portfolio that has actually returned more than a passive benchmark with slightly lower level of risk. And that's really the goal of our portfolio management philosophy. So this is a version of the proof statement. As long as this is positive, I get to come back every year. So this is one more year. By the way, this is 18, so my 18th annual meeting. Pardon me, my 18th annual conference. So what this shows is the growth of $10,000 from 1975 versus the actuarial rate of assumption, which historically was 8%, and now it's currently 7.75. And what this shows is the fund has earned 67.8% more than a steady 8 and 7.75 return. So what that shows is even though there's volatility in the portfolio and we have down years, over the long run, we make more money through a diversified portfolio. So where are we at today? In 2016, the board approved a new asset allocation, and within that, we have the ability to make shifts. We can overweight or underweight stocks and bonds. Since the end of the second quarter, we've reduced our equity allocation, our stock allocation by 5%. Primarily that's come from the US, which I'm going to show in a couple slides, has had a great run, and we love the US market in the long run, but the stocks are definitely overvalued there, and we've left some overweights in international and emerging markets. Those have not performed quite as well, but from a valuation perspective, we think it's better to have money in that part of the stock market at this point in the cycle. We've also increased our fixed income allocation, and one of the things that we've done is we've weighted the short end of the curve. And so what I mean by that, bonds that mature in 1 to 2 years versus bonds that are maturing in 10 years. And that's probably your mom. And that's actually been a really good change, because when interest rates go up, as they are in the US, your bond holdings go down. And so our fixed income portfolio is outperforming, and so that shift has been really good. And then additionally, in the private markets, we're making investments in agriculture and healthcare exposures. So those are tailwinds to the markets. We're going from 7 billion people on this planet to 9 billion people, and we're all getting older. I'm getting older, and the world's getting older. And it means there's going to be opportunity in the healthcare space. So that's an area where we're looking for niche investments, which we hope will move the portfolio up over time. So this shows the price-to-earnings ratio of the S&P 500 since 1900. So this shows it's a proxy for the cheapness or expensiveness of stocks. And what you can see here is we're at the second highest valuation since the dot-com bubble. So this is a data point which tells us it might be time to take a little risk off the table. Right here, this shows the green bar would be the US stock market, and then the orange and yellow would be Europe and emerging markets. And what you can see here is the US stock market is overvalued over really, over the last decade. So again, another data point that says might be time to make a little bit of a shift in the portfolio. What you see here is on the right side is the target allocation. So this would be our neutral stance if you don't really have a view on what's going on in the market. And we've got global equities at 55.5%, fixed income at 18.5%, real assets at 13.5%, and diversifying strategies, which we hope will return kind of between stocks and bonds, and it's actually done that, at 12.5%. Then if you go over to the left side, you see where those positions were at the end of second quarter. And actually going in the midpoint, we were overweight stocks. So in the last couple months, we've reduced that. And I would just highlight that you see real assets and diversifying strategies are below their target allocation. That's simply not really a case of adjusting to the market. We're just looking for opportunities. We started building out those portfolios in 16, and we're just, when we see an opportunity, we're going to invest, and if not, we're comfortable with that slight underweight in those areas. So now what this shows is the performance of value versus growth. And when I say value, what I mean by that is we tend to favor, when we invest in equities, companies that actually have earnings, that produce dividends, that also provide some downside protection, to the portfolio. And what this shows is if you have a value bias, the trend line is up. So this goes back to 1974. If you're a value investor, you've done better. So this is one of the things in investing that we know it's like diversification. It's a bit of a free lunch. That said, you have periods where value is out of favor. When stocks were running up in the dot-com bubble, I remember 1999 and 2000, everybody was smart. Stocks were going to go up forever. There's a few people in the room that remember that. You're going to make 18, 19% in your 401k. Well, that stopped. And what you see is when that's going down, those little troughs, growth is outperforming value. So, and you can see since the stock market's done great since the global financial crisis, since 2008, but we think that that's about to turn. Another couple data points we look at, this measures leading indicators and consumer confidence. And what you can see here is they're at pretty near historic highs. Again, this tells us that the market is a little bit exuberant and they're discounting that a recession may be in our future. So this also is another cautionary data point. And again, highest level since the financial crisis. Now that said, remember, the U.S. economy is currently strong, and I'm not anticipating that things are going to fall apart in the next couple of weeks or even the next couple of months. But the business cycle is a cycle, and things start at the bottom and they go up. And at some point there is a downturn, and we're trying to position ourselves to take advantage of that. This is a little bit busy, but the key takeaway here is the kind of red lines are U.S. recessions. And when you see and the bottom line is when you see the chart kind of come down, that's a case where the cost of borrowing at the 1 to 2 year is very close to that at the 10 year. So when you hear people talk about the yield curve flattening or inverting, that's all that means, is the price you get paid for a 1 or 2 year bond might be 3%. Let's say at the 10 year it's about 3%, or let's say it's 2.8%. About 9 out of the last 10 recessions have been predicted by that. Now we're not there yet, definitely not there yet, but you can see the trend line is going down. So this definitely gives us some pause, and is one more data point that says we might want to take a little bit more of a cautious approach to our positioning in the portfolio. So I think one of the things that one of the takeaways is our portfolio is designed strategically to protect on the downside and take advantage of long-term trends in the marketplace. But how have we done? So you can see here, that's 2008. It was a scary time. Scary, but much less scary if you were in the MERS portfolio. I'll go to the .com, which is 2000-2003, that was also tough. Again, U.S. stocks lost 40%. MERS portfolio significantly less and bounced back quicker. And the key thing about this is we cannot, we have to invest in the stock market because that drives returns. But at the end of the day, too, when I got here, we were paying out, I think it was like $11 million a month in pension payments. Now it's like $74 million a month. We're a mature plan by design, and that's okay. But that's another factor. We need to take into account that we have to make our pension payments, so we have to have a mix of stocks and bonds so we can meet our obligations. Because the last thing Chris wants to hear me say is, by the way, you're going to have to call Hillsdale and say, you got to wait a couple weeks for your pension check. So that's an overview of the portfolio. And now I'm going to invite the team up here, and we're going to have a discussion about investment plan governance. And then during that, we'll be happy at the end to answer any questions you may have.
Well, good morning once again. My name is Jim Wiersma. I'm the president of Family Investment and Resource Management, a small investment company in Holland, Michigan. I've served as a public member of the MERS board since 2009, and for a number of years now have been the chair of the investment committee. I'll be moderating this session, so before I get going on that, I think I'd like to just briefly introduce the panelists who are up here with me. First, on the far side, Jeb Burns, who you have just heard from. Next to him is Ed Michaele, who is the director of our private markets team, and he's been a long-term member of the investment business and has been with MERS since 2013. In addition, he's, I think, accumulated something like 20 years worth of experience in private markets type work at MERS or elsewhere. In the middle is Mike Gilmore. Mike is the Vice President and Chief Investment Officer at Delta Dental of Michigan. He's been on the MERS board for a number of years as well and joins me on the MERS Investment Committee. And then right here is Mike Charette. Mike is sort of Ed's counterpart and is responsible for the public markets programs at at MERS and has been a part of the MERS investment team for 16 years. So as you can see, the MERS team is an experienced group of individuals and has been at this business for quite some time. I would like to highlight that during the course of our discussion here this morning, you're free to send any questions to us through the conference app, and I think, yep, the instructions for doing that are up there on the screen.
Jim, we were pretty clear that we were only going to take the easy questions.
Easy ones,
Right.
yes.
So,
Yeah.
hard questions, you just keep those to yourself.
Right, right. Although I've got a couple of, ringers in my basket just in case. Well, with those details out of the way, then I think we'd like to get going. Jeb, perhaps you could begin by just giving us a little bit of a description of how the investment team at MERS has been built over time, kind of what your philosophy for that is, and then how both the team and the philosophy of investments is kind of integrated into the way that we approach investments at MERS.
Yeah, I think, I'll go over kind of the org chart first and kind of get into kind of the team development and my philosophy for managing the team after that. Because I think it's important, you see the chart you see up on, actually behind me and in front of me. It's important to know that the management of an institutional asset pool, it's a business unto itself. And so there's really three components, and it's pretty common in most places. You can see here, Ed heads up the private section that tends to be a little more labor intensive. There's distinct nuances to managing that business. He'll interface very closely within the bottom. You'll see Brian LeVictor is our Deputy General Counsel for Investments. Then you've got Mike Charette, he heads up the public market section. And then beyond that, you see Peter Lykowski at the bottom is our Investment Administrative Officer. When you manage a pool of about $12 billion, the actual, keeping track of the investments, setting up the accounts, and then making sure that you're adhering to the regulatory and governance requirements of at the federal, state, and actually at the plan level, that in itself is a business all to itself. So there's really kind of three components of the structure of how we run things. And then kind of beyond that, how we work as a team. It's a small team, there's 9 of us right now. So while there are 3 distinct units, there needs to be cross collaboration across each one. So we make sure that there's a culture of collaboration and actually functional tension, that I like to term it. People need to be very comfortable kind of butting heads, expressing their opinions and challenging ideas, because the worst, I know what I think, I've got strong opinions, but I need to know what you think. And that way I think we get to a better solution. I think we bring that to the investment committee as well. I have a developmental style, so I believe if you give people the tools, you give them some structure, that they'll thrive in that environment. And the way we built the team is Ed was somebody that we found him wandering the streets. It was sad. He needed a job. But a lot of the team has come to us through, we developed an internship program with Michigan State. So we really get their best and brightest, and we run them through. We try to have 2 on staff at any time, and we've hired 4 over the years that work in the team. And that's a really good way of, they spend a couple of years with us, you get to know them, they actually kind of create their job as they go. And I really believe it's not me, it's the team that gets things done. And I think it's making sure that you have kind of that collegial dialogue and really functional tension within it allows us to be successful.
Okay, good. Thank you for that. Mike, Jeb has described a little bit of how things work sort of inside the organization, but there's also a governance structure that exists somewhat outside that involves both the board and the investment committee. Could you talk a little bit about how, in your experience, that's functioned at MERS?
Sure, and good morning, everybody. I have the good fortune to sit on the investment committee with Jim and Michael Brown. So there's 3 members of the investment committee that are board members as well. We also have an outside observer from the board that gets to also participate in a 2-year rolling period. I would encourage you, if you have an opportunity, or if you haven't already been to Mike Overly's session on governance. He lays that out really well at the front end of his discussion. So if you haven't attended that, I would encourage you to do that today. I think there's an opportunity to do that. But our opportunity to interact with the investment team in a little bit deeper basis in the investment committee, because we essentially are the policy development arm of the board. We can ask some little deeper probing questions. We spend a little bit more time with the investment committee and help to vet some of the recommendations and some of the ideas and some of the thoughts that the investment committee team is pulling together. And I will say that I'd put the investment committee team, or the investment team that Jeb's pulled together, against anybody in the country. Not only are they incredibly intelligent and creative in some of the ideas that they have, they also have a really good way of working together. So when we're in these meetings, sometimes it can be, as Jeb has indicated, we can ask some tough probing questions that may make people squirm a little bit. This team has no problem responding to those questions that we may have. And if we're not fully satisfied with the information that the team can pull together and respond back to us, they're more than willing to go back and work on it. And we're more than willing to hold their feet to the fire, if you will. And I also should say, for what it's worth, for me, it's personal. The performance of the portfolio is personal. My father-in-law is a retiree of the Central Michigan District Health Department, so I have to answer to him when I see him. And then my brother Kevin is also a police officer in the Novi Police Department. So for me, it's personal for me. It's not just a pot of money, and it's not like that for any of these guys. It's personal for all of us.
Thanks, Mike.
Yeah, Jim, if I could just jump in.
Certainly.
One of the other things that we have is, in my team, we have what I call our portfolio review committee. So think of that as an internal investment committee group. And so we actually, ideas need to come to the group twice. So due diligence, documentation, and then a formal vote takes place. So by the time it gets to the investment committee, we've really kind of stress tested that idea and done a lot of research beforehand. And so that's like another level of due diligence that goes into the process. And I just want to reaffirm that, if we can't answer their questions, then our work isn't done. And, Mike's been with me for 16 years, and we've felt very comfortable with that. What we do is complex, and, if we can't articulate the answers clearly so that they're comfortable, then that also tells us that, there's some risk here. There's some complexity risk. We maybe don't quite understand it, and it forces us to go back and sharpen our pencils again.
One of the ways we kind of stress test ideas too in those committees is we'll almost assign a devil's advocate, somebody whose job it is to kind of think about what could go wrong with an investment and really kind of stress the person who's doing the due diligence on it to make sure that we really have sharpened our pencils and dot all the I's, cross the T's.
Okay. Our portfolio, as you've heard earlier, is constructed of a variety of different types of investments. You saw a reference to diversifying strategies and real assets. On the pie charts a little earlier, Ed is responsible for some of those more complex assets that you just can't kind of call up a broker and readily buy. So Ed, could you talk to us a little bit about kind of what the differences are between kind of the way the private market portfolio kind of comes together and is supervised as opposed to kind of the public markets?
Yeah, sure. So, just as far as the approval process goes, it's very similar between the public markets and private markets. So it needs to get approved at the Office of Investments level, and then proceeds to the board if it passes the Office of Investments level. One bit of difference is that the deals in the private markets tend to have a lot more devil's advocates than the public market deals. So I end up answering a lot more questions within the team. But beyond the internal approvals, the one big difference too is the way we manage the investments to the outside. So once an investment does get through the approval process, we try to be active in the management of those private investments through participation on the boards of directors of individual companies that we might invest with, or if we invest with fund managers, we try to get on their investment advisory boards or their investment advisory committees, so that we really play an active role in those investments that take a longer time to develop. and are harder to get in and out of on a daily basis. They're not freely traded in public markets. So we try to maintain an active role once the investment is actually consummated to make sure that, that it goes the way we want it to go. And if there is a problem, that we're involved in what the solution might be.
Does your job involve any international travel, Ed?
Yeah, more than I care to admit.
I imagine. All right, moving on to Mike. Mike, one of your roles, in addition to just purely the public markets, is responsibility for the investments that make up our participant-directed accounts. Could you talk a little bit about our processes there?
Sure. Thank you, Jim. The governance structure for our PDA programs is clearly defined in our investment policy statement, which is available for anyone to view on our website at www.mersofmich.com. So the retirement board is the sole fiduciary of the system, so they're responsible for establishing that IPS and all of the other investment policies. And then the investment committee monitors the adherence to these policies. The investment committee works with the recommendations from our Office of Investments, and they set the default option and then approve the number and the types of investments that are offered on our investment menu, including the addition and deletion of any of the investment options. And then the Office of Investment, we conduct the due diligence on both selecting and monitoring those investment options that are offered to participants. We complete a detailed review on each option every quarter and make sure that they're meeting their objectives. So the menu's on this screen to my left and right, and we think we structure it in a way that makes it pretty easy for our participants to understand. So the first column, we have the retirement strategies. And those are commonly known in the industry as target date funds. And so with that, you select an option that's closest to the date that you anticipate retiring. And then the portfolios are fully diversified with stocks and bonds, and then they're automatically rebalanced over time. So the glide path, which you can think of as the asset allocation, it gets more conservative over time, which reflects the nature of most investors' risk tolerance how it changes as they get closer to retirement. And then after that retirement strategies, we have what we call our premium select options. And the first one is the portfolios that are built for you. So again, these are asset allocation portfolios. The main difference between these and the retirement strategies is that the asset allocation is static over time. So those are rebalanced quarterly, but they're rebalanced to whatever that target is. So that is not going to, the asset allocation is not going to change and grow more conservative over time. Those portfolios are created alongside our DB portfolio, which allow our PDA participants the ability to benefit from the economies of scale that we have within the defined benefit program. And then for the more experienced investor, we offer the funds to build your own portfolio, which are individual funds with specific specific targets. And then for the really experienced investor, we offer a self-directed brokerage window, which is a way where you can invest in additional mutual funds and even specific individual stocks and bonds.
All righty. While we've got you talking here for a second, one of the other responsibilities you have is our internal asset management program. Mm-hmm. We've got a couple, I know, of portfolios that focus on U.S. stocks in particular across a variety of asset cap sizes. Could you talk a little bit about how those portfolios are managed and some of the advantages that we derive from managing internally?
So that's been a big theme of ours over the last 5 years or so. But we started managing assets internally in 2003. We started very simple with just a portfolio that mimics the S&P 500 index, and we built that out with some other S&P indexes. In 2011, we created our first active equity strategy, and so we have it's all model driven, but the model has some value components, some quality components, and then a little bit of momentum and growth. So we manage about 30% of the portfolio internally. Again, most of that is in the U.S. equity portfolios. We also manage a short duration portfolio, so our cash allocation, which is any bonds that are basically have 2 years to maturity or less, we manage those internally. And the main reason for that is for cost savings that we're able to pass on to participants.